Okay, welcome back. I mean, have to say that early, very sharp losses across Asia have pulled back. I mean, Hang Seng, for example, was down 4, but it's down 2. And in line with that, I mean, the SGX was down some 80 points when we started at 8 in the morning. We're down about 55 points. So there is a little bit of pairing of that sharp cuts that has happened already. Anuj has hopped across to our studios to tell us what he's watching out for in terms of trade setup. Anuj, hi, morning.
Morning, Prashant. Morning, everyone. Look, I think this morning's big news is what's happening in China. I think normally China's pain is India's gain. We actually outperform when China falls like this because it's all about ETFs, which shift and sensing momentum into India, which is at all-time highs. Crude's down, dollar is down. I think buy on dips really remains the only theme. I think you've seen that play out a bit, SGX Nifty already. The only caution factor, and we discussed it, over the weekend, is the overbought nature of the market with Nifty futures premium of 133 point and FI long exposure where it is. But if ETFs again start to buy, I think that would be an interesting thing. On the Nifty, I'm tracking two levels. First is Friday's low of 18,445 on spot. That is crucial. And I think normally on days like today, you have algo trades which play with the SGX Nifty as low. SGX Nifty low as stop loss for futures. Normally you buy, in first hour and put that as a low. That trade normally works. 18,250, of course, is the base for the market. I think for the Nifty, keep an eye on Nifty IT because if the market has to reverse, the first reversal signs will come from Nifty IT, which really over the last 2 days has been the strongest index. On the Bank Nifty, you have seen some call writing at 43,000. So 43,000 to 43,300 remains the resistance. But I'll be watching out for Nifty IT and for mid caps and small caps to catch up from here on.
Okay, all right, Anuj, thanks a lot for that. Well, let's hop across to Ashish Chaturmota, Director Head at JM, who joins in JM Financial Services, who joins us. Hi, Ashish, good morning. Tell us your F&O strategies for today.
Hi, good morning, Nigel. So I think, broadly, at an index level, we are at an all-time high, and the way we have been consolidating, it looks like, any dip is going to be an opportunity to go long. The only change in, in the behavior of the market is that, till now we were seeing a very strong outperformance coming from financials and banking and financials. But there, I think now we are going to see a relatively better performance coming from Nifty. And obviously, Anuj has mentioned about IT index performance, and that's where the major, strength is looking like. We have seen a strong double bottom breakout on the Nifty IT index, and that's where I think the long has to be created on the IT stocks. So first long call is on Infosys, where I think a good breakout has happened. Keep 1600 as a trading stop loss in the immediate short term, looking for 1700, but positionally I think stock is poised for a move towards 1800 levels. In the mid-cap IT, I think persistent is a very, very decisive breakout on the weekly, monthly chart frame. And I think the way OI buildup has happened in the persistent stock, I think it looks like stock is poised for a move towards 4100 levels. So one can initiate a long, keep 3910 as a trading stop loss. And upside 4100 would be my short-term target in persistent. Capital goods space is showing very strong traction. So whether it's L&T, Cummins, we are seeing a lot of build-up in the stock. So I think Larsen & Toubro would be my preferred pick with around 2020 as an trading stop loss. Stock is poised for a new all-time high target of 2200 zone. So I think L&T would be a top pick in the capital goods space. And last but not the least is Reliance. The way Reliance has been consolidating, and on Friday's trading session, we have seen a good up move coming into the stock. The stock is looking good for 2700 kind of target. So keeping 2590 as a trading stop loss. Reliance would also be my top pick. So all in all, I think a lot of index contributors are showing good strength, and that's why I think any dip towards 18400, 18380 would be a good opportunity to go long even at index level.
All right, Ashish, we'll leave it there. Thank you very much. Great speaking with you as always. I mean, the pre-open rates are coming up on your screen. There is a very large move on the rupee as well. The rupee dollar is starting about 10-11 paise weaker as compared to the dollar. But I think this is also, the impact of what's happening in China, which is the dollar is appreciated very strongly, did appreciate, although losses have been cut a little bit. But there is a broad uptrend in the dollar, which we are seeing across most Asian currencies. 90 points lower, but this is the beginning. 3-4 minutes more, and then these rates will settle down. Prakash, just a few other names. I mean, if you want to very briefly touch upon, names like Religare came up very sharply. UTI AMC on Friday was a big mover. Kajaria was a very large mover. Then there was Paytm, Policy Bazaar. Any pick out of these?
Not specifically, to be honest, Prashant, but what is the market telling you that, these are names, some of these at least, like UTI, AMC and all that, you really don't talk about or hear of very regularly these days. The market's gearing up for some sort of a rotation within the mid-cap, small-cap space for sure. And there's this huge catch-up that's probably, underway. And that's exactly why you'll have to put your bets on the right kind of stocks which still have enough room to go. So, for example, the fertilizer stock, you saw the kind of run-up. It stemmed itself after a while, but there's still a lot of changes in the fundamentals that could move. So, the likes of a GSFC or an RCF, or, these are names that will probably start featuring much more prominently. So my sense is you'll see shift into IT and some of the cyclicals, maybe cement, maybe paper, all of those names will come back, especially the small cap, mid cap. So keep a watch on that. Nothing specific from these 4-5 names because we've been talking about that regularly. I didn't see anything which is very promising, at least on the Friday session.
Prakash, we leave it at that. Thank you very much for joining in. By the way, in the pre-openings, there are a few stocks which stand out. One are the oil marketing companies. With the decline in crude prices, it's positive for oil marketing companies. So BPCL in pre-opening is the big gainer, and Hero MotoCorp, after the company undertook price hikes to the tune of 1,500 rupees for its two-wheelers, that's higher. And on the losing side, Paytm is likely to take a big knock, it appears, in pre-opening, 7.5% lower after RBI has disallowed the company from onboarding new merchants. So the street is clearly worried. There is a big knock seen in Paytm. But let me invite now Sterlite Technology. We didn't chat with them when the numbers came out. We're now joined by the company's MD, Ankit Agarwal, on the show now. Hi, Ankit, thanks so much for joining in. You typically classify your business into the optical fiber business, which is about 75%. You have services, about 25%, and there is a very small portion of digital wireless. So when I look at the margins this time, there is an improvement on a quarter-on-quarter basis, but that's led by an improvement in the optic fiber margins. Your services business margins have come under severe pressure, and I think it's down to just 2.5%. Could you tell us the reason why, and do you anticipate an improvement in the service business margins from here on?
Yeah, thank you, Rima. Good morning. So I think the first part is, one, at a global level, we continue to see pretty strong demand for the optical products in particular. And there we've really tried to focus, and we've taken an ambition to be the world top 3. So that's something that's very, very exciting for us. At the same time, on the services part, there are 2 parts to it. One, we've done a conscious shift from a focus on government projects to more and more private sector projects. And that we are looking at how to improve the margins in India, particularly, from around 7-8% to about 10 to 12%. So that's work in progress, but we're confident on the back of 5G and other projects which are coming up that we will be able to execute on that. And the second part is that we have also expanded in terms of our services business in UK, which is currently in losses. And there the work is to turn that around and make that profitable. So as we do that, we believe that the optical business will continue to have north of 20% EBITDA margins, and the services business should come back to 10 to 12% margins.
By when can service business margins get back to 10 to 12%?
We believe in H1 of next year.
H1 of next year, okay.
All right. Hi, Ankit. Ankit, your optical interconnect opportunity is rather large. And you've been talking about, interconnect rates hit closer around 40% odd. What's the incremental opportunity for you? Can you quantify this?
Yeah, absolutely. So what we call it is the attach rate. So essentially, the optical fiber cables and the interconnect are typically sold online, are sold together as a package solution. And what you have also when we see our global peers is a typically 1-to-1 ratio. So for every cable that we sell, $1 of cable, we can sell $1 of interconnect. And that's very powerful for us to get better lock-in with our customers as well as improve our margin portfolio. So that's the ambition, that we get to about 40% by FY25. That's what we have shared with investors. Currently, we're at around 10% or sub 10% range. And as we get more and more of our cable customers to also see the value in the interconnect, we believe that should start increasing quarter on quarter.
Ankit, hi. Good morning. Prashant here. Could you tell us by when will you decide on the Italian expansion?
Yeah, so just on the optical part, overall, there are three things going on in parallel. One is our US facility is coming on stream. That's something we're very excited about to serve the US market. We're already at 14% market share, and we want to further grow on that. Second part is in Europe, we are now north of 20% market share. And on the back of our Italian facility, both on cable and interconnect, we want to grow that. So in the next couple of quarters, we will further increase our Italy capacity to full utilization. And then we have some small addition in India. All of this combined will take our cable capacity from 33 million to 42 million fiber kilometers broadly in the next 4 to 6 months. So that's when we see that capacity coming on stream and utilized. On top of that, we are also increasing some capacity on our interconnect, particularly in India, to make sure that we can scale up that part of the business.
Okay, so your overall capacity will rise from currently 33 fiber kilometer to about 42 fiber kilometer in the next 4 to 6 quarters.
4 to 6 months.
4 to 6 months. Okay. So by the end of FY23, can you tell us how optic fiber cable prices have moved? What has been the overall increase seen in the first half of the year? And is there scope that it rises further from here?
Yeah, so we've seen actually pretty strong demand, particularly in our focus markets across Europe and US. We continue to see very strong capex investments on the back of 5G, fiber to the home, as well as very large spends which are committed by the government. Just the US market itself, government has committed $65 billion for broadband connectivity. Similarly, countries like UK, Germany, and of course in India, we have projects like BharatNet as well. So all of this caters to very, very strong order booking for us. Last quarter, we had one of our highest ever order books, north of 3,000 crores. And we're overall having an open order book north of 11,700 crores. So it's pretty well set up for us in terms of the orders we have. Our focus now is to make sure that we can continue to serve our customers with new innovations and new solutions, which can further improve our margins. One other part that is also benefiting us is we're starting to see the container prices starting to come down, and was probably come down by about 20 to 25% from say 4 to 6 months ago. Okay. So that should further improve on our bottom line. But we still face some challenges on our gases, particularly helium, which is obviously a global shortage right now.
Okay. All right, Ankit, very quickly, we're getting to pre-open, but your debt numbers are around 5,200 crores odd. There were indications that you want to bring that number down. So could you tell us what is the targeted debt number and any progress on the new CFO?
Yeah, so our debt number is around 3,200 crores. Oh. And the focus is to overall take our net debt to EBITDA at about 2.5. So that's the focus for us. We are seeing our performance improvements as we go into Q3 and Q4. And overall, we expect our revenue for the year to be north of 7,000 crores. So that's on the performance side. On the CFO, as I had shared earlier also, we're a few weeks away from announcing it. We're very excited with the new CFO coming on.
All right. Ankit, it's a pleasure. Thank you very much. But by the way, guys, I don't know if you know, Ankit is an accomplished musician as well. And, I mean, so is Prateek, and completely musical family. Ankit, it's a pleasure. Next time you're on, we'll start with a request for you to sing.
With a jingle.
Great speaking with you. Great speaking with you. Thank you very much, Ankit. Appreciate it. All right, let's get our 9-10 calls now. So we're at what, 9-11, just heading into market opening, 4 minutes out. And as I was saying, I mean, it's the losses are there, but 40, 50 odd points. It's not a large one like how the SGX was indicative of earlier. Okay, that's an 80-point cut. Sorry, beg your pardon. 0.4% lower at start. Sudarshan is here. Sudarshan, what would you do looking at the pre-open?
I would avoid the Nifty and the Bank Nifty trading today. Markets can have a deeper, say, correction or a sideways move. Best to stay away. BPCL is a buy with a stop under 311.
BPCL, right? That's Bharat Petroleum.
That's right.
All right. Mitesh, what about you?
I'll also go with the buy call, and I'll choose a buy on L&T Finance with a stop at 84.5 for targets of 92.
All right. Thanks very much, Mitesh, for running us through that. Sudarshan, thank you very much as well. Nimesh is standing by with the Standard Brokerage report. Nimesh, what do you have?
Hi, Prashant. So today's standout is on Apollo Tyres. In fact, there has been multiple upgrades of late. And today, UBS has gone ahead and raised the target price on Apollo Tyres to 355 versus 295 earlier. They expect ROE to double and debt to halve by FY25. Commodity prices have started cooling off, and that's going to aid to the gross margin. So for FY24 and FY25, they're expecting EBITDA margins to improve to almost 13.5%, 14%. versus 10.5% in second quarter of FY23. In fact, they expect ROE to inch up to almost 13% in FY25 versus 6% in FY22, and the debt to decline almost to 2,600 crores versus 5,500 crores as of current year. So that's going to be a big shift there. While the stock has seen a bit of a run-up, they still believe the valuations are attractive at 12 times FY24 price to earnings versus the industry peers, which are trading between 17 to 24 times FY24. So valuation attractive, there is cushion, and ROE is likely to double in the next 3 years. So they've raised the target price in Apollo Tyres to 355 now versus 295 earlier.
Nimesh, thank you very much for that. Sonal is here, and she's going to tell us the JP Morgan view on oil marketing companies. Sonal?
Well, yes, JP Morgan has turned constructive on oil marketing companies. In fact, they've gone ahead, upgraded HPCL to a buy with a target price of 285 rupees per share. They've downgraded GAIL to a neutral, though, with a target price of 105 rupees per share. They expect oil prices to stabilize going forward with some downside risks as well. And policy support, they think, for oil marketing companies has turned positive with more LPG subsidies kicking in as well. And that's the reason they think that there is a positive bias towards all these companies. OMCs are profitable now as far as petrol and LPG is concerned. Diesel is still seeing some losses, but they are also down sharply from the highs. And that's why this positive view on all the oil marketing companies.
Okay, all right, Sonal, thanks a lot for that. Well, we're just a few seconds away from pre-open. As we stated, the Nifty Bank is likely to open up the cut of more than 200 points. The Nifty is likely to open up with a cut of closer around 82 points odd. But let's see where we go from there. In pre-open, well, a couple of stocks that have opened up with a bit of a cut on the Nifty itself. You have HDFC. That's the key reason, actually, while the Nifty is showing a bit of a cut of around 80 points. Just a few seconds, and we get straight into that. Breadth of the market, though, is looking at least good in pre-open. Well, initial rates come in, and because of the uncertainty in China, you have Hindalco that's pulled back, JSW Steel as well. So metals are taking a bit of a knock. The metal index itself is lower. HDFC and HDFC Bank, those two large weights, well, they can swing the index around for the time being. They've opened up with some red on the screen. A couple of other big stocks that are moving around. In an otherwise wobbly market, you have BPCL. That's up close to around 1%. Sonal just told us about the JPM note on OMCs, and that stock, in fact, is moving higher as we speak. Hero Motor as well as Tata Motors, both those two stocks trading a bit in the green. Well, the mid-cap index, well, it's moving higher, so that's a good sign, at least at the start of trade. In Friday, it moved higher, so that one's moving around. You have Max Financial because of that relief that's come in there and the clarity that's come in terms of that stake. It's up close to around 5%. So a big bounce is what you're seeing. OMCs, they are really the sector to be in today. HPCL's up 3%. You have IOC that's up close to around 1.5%. And Nimesh has told us about that note on Apollo Tyres. Well, that one's up close to around 2.5% odd in a special segment that's standard brokerages. On the flip side, IEX, the market would like a tender buyback. They've come out with the open market purchase. So the street is a little bit disappointed. It's down close to 100%. And GSPL as well, down close to 100%. Rima, what else?
Well, the mid-cap index, for starters, is open in the green. So the mid-cap index is up close to about 0.3%. So the outperformance, which we saw last week, has extended this week as well, Monday morning. The advanced decline ratio is positive. 5 stocks in the green for 2 in the red. A couple of these smaller stocks, so Ami Organics as well as Shriram Properties, where there is news flow, have opened with strength. So Ami Organics is currently up close to about 5%, while Shriram Properties is up 2.5%. On the losing side, Paytm is a bit subdued. Not as bad as what the pre-opening was suggesting, but Paytm has opened with a cut of close to about 2%. A couple of other names. Max Financial is now picking up significant, seeing a lot of traction, up 5%. MSTD, MSTC, ITDC. These are stocks which are higher in trade. Rail stocks like TexRail are up close to about 4%. Apart from that, as Nigel pointed out, it's the oil marketing companies. So HPCL too, in the mid-cap space, is currently up close to about 3.5%. So this decline in crude prices is positive for them.
Oh, absolutely. I mean, just 35-point knock, right? I mean, 18,479 is where we are already at after a lower start. So this is pretty good. I mean, 18,480 on the index. Let's just have Max Financial sort of pulled up once again. Take a quick look at it before we go any further. The stock had seen such a large price damage. I mean, even compared to other insurance companies, life insurance companies, which themselves have been relative underperformers. I mean, I think Max has really seen the bottom fall off, but now it is coming up a little bit. I just had to point out that the approval from IRDAI, which has come through this morning, is for Max Mitsui. it's not the big one, of course, is going to be Axis Max. Axis is stake purchase into Max Life, around which there has been doubts in terms of what the regulator is going to do, etc. The management at Axis had kind of addressed that in their conference call as well. So this is with regards to Max and Mitsui, the Axis one, of course, is not something which has come through this morning. 700 though on Max. It's coming off, of course, extremely beaten levels. So seeing some traction. Our market master of the day is with us. Pankaj Tibrewal is Senior Executive Vice President and Fund Manager Equity at Kotak Mahindra Asset Management Company. Pankaj, great to have you with us here. Thank you very much. Appreciate it. Are you, Pankaj, constructive near to medium term, or are you a little cautious with the run that we've had now?
Good morning, Prashant. Markets are at all-time high, and I think markets are discounting most of the positives today. Markets are saying that India will grow much better to the rest of the world next year. Inflation would be under control, and monetary tightening won't happen the way it has happened in the West. So I think markets are discounting a lot of positives. However, at this stage, there are some red flags emerging post the second quarter numbers, and we need to take cognizance of that. The first one is that after a long time, maybe 2.5 years, we are seeing corporate profits starting to decline. And if you take the NSE 500 universe, 30% of the companies had a profit degrowth. The second most important point is that after 2.5 years, the NSE 500 companies have seen contraction in operating cash flows. And Prashant, don't forget that always cash flows leads earnings. And if you remember during COVID, first the cash flow started improving, and then it was followed by earnings. So that's one thing we need to keep in mind, that 60% of BSE 200 companies have seen deterioration in working capital. And if you combine that with the liquidity deficit which we are seeing in the system, there's a point of concern. The third point is that EBITDA margins have come below the June 20 quarter now for corporate India as a whole. Let's see if commodity prices starts declining and there's some revival on the margins, but corporate EBITDA margins are almost at a 8-quarter low. So these are 3-4 points we need to keep in mind as we rejoice the all-time highs into the market. And finally, if you look at the top 500 companies for the second quarter, there was a headline degrowth of 3%. But if you take the non-BFSI companies, because BFSI sector was the shining star, the non-BFSI 380 companies saw a degrowth in profits to the tune of 26%. So over the last 2 quarters, we have seen about 4 to 5% downgrade in earnings in Nifty. And that, I think, we need to consider, because valuations have no longer become cheap. They are no longer cheap. They are slightly higher than their long-term averages. And when you look at the relative valuations, I think we are extremely stretched. Compared to emerging markets, we are trading at 100% premium. And compared to the rest of the world, our premium is to the tune of 25 to 30%. So at this point of time, a slight bit of cautious view on the markets, that we need to take into consideration the corporate India performance after the second quarter numbers.
Morning, Pankaj, Rima here. Just to dwell on that point about the contraction seen in the operating cash flows of the NSE 500 companies. Is this a harbinger of capex slowing down, demand slowing down? Because the street is very bullish on the manufacturing opportunity and stocks have done exceedingly well. If the cash flows are under stress, do you think we could see a slowdown in capex from here on, more than something that the street is not talking about right now, and that could be a big risk?
Normally we have seen that, but I think it will be too early to call out for that, because there are other factors, which is the balance sheet of corporate India, thankfully is in best of the shape. So I think still there's no room for a big concern out there on a balance sheet perspective. And if you look at over the last decade or so, Indian corporates are delevered themselves, and the debt to EBITDA ratios is one of the best globally. So little bit of concern, less concern out there on the balance sheet side. But yes, we have to watch out in the second half that how this working capital behave. If we continue to see deterioration in the receivable cycle, we continue to see deterioration on inventory cycle, then yes, obviously there will be a point of concern. But this is one red flag which I wanted to kind of talk about as we kind of celebrate the all-time high with the market.
And hi, Pankaj. Morning. Always good hearing your thoughts. And you're putting some caution out there. But in terms of an approach, then, if incremental money needs to be allocated, where would it go?
I think it was a perfect quarter for banking. And I think over the next couple of quarters, banking will continue to show strong results, especially the private sector banks. And we are positive on the name. The second, I think, is that IT had a bad year this year. I think there will be an inflection point in IT over the next couple of quarters. And probably at some point of time, IT will start to look attractive. And we are keeping a close watch on that. The third is I think the entire industrial capital goods cycle. We believe that there are various themes which are getting aligned for the sector. And when we traveled across the country, the kind of positivity we are seeing among the Indian entrepreneurs, especially in the engineering, light capital good, precision engineering, is we have not seen for more than a decade. So I think that segment looks to be quite good. Defense is another opportunity which is looking nice from a slightly medium to long term. But however, in the near term, valuations are a bit stretched, so we need to take a bit of cognizance of that.
Pankaj, hi. Just a quick point, just if you can dive a little deeper into this operating cash flow point that you made, right? Which sectors, especially which pockets, I'm sure you looked at this data in a more granular level, is this coming up the most, the stress coming up the most?
So cash flows, we have seen decline across capital intensive sectors, especially metal, cement, chemicals, and some of the other capital intensive sectors. Whereas some of these sectors like auto and all have seen improvement in cash flows. So there are a few pockets which have seen decline in profitability also. And also we have seen working capital deterioration in many of these sectors which I just spoke about.
Cement has seen deterioration. The other one is metals. Was there a third sector?
Cement, chemicals.
Chemicals. Okay. And would you be cautious on any of these three segments given the points that you've highlighted? Is it time to take money off the table, perhaps?
We have been a little cautious on the metal sector for a while. We believe that China, a lot of uncertainty is there. And over the last couple of days, we have seen uncertainty actually increasing led by COVID. So China is an important country or economy from a metal perspective. And we believe that volatility is there to stay in the metal sector for some time to come. And that's one of the sectors where we are underweight as a portfolio.
All right, Pankaj, what about the auto space? You know, it had gone through it hit a bad phase, and then things started turning around. Commodity prices cooled off, the chip shortage issue started sorting out as well. But in the last 45 days or so, actually, that index has been a relative underperformer. How much of the good news is already in the price?
So auto, I think you have to divide, Nigel, into two parts. One is the passenger vehicles. The momentum out there continues to be good. And I think there is a pent-up demand which is playing out. And across the segments, month on month, we are seeing that the autos on the passenger vehicle continues to do well. On the other side, you have the two-wheeler segment, where we believe that there's some more pain left. And rural is not showing signs of recovery. And I think that's badly impacted because of that. And if you look at overall consumption basket, the lower end of the pyramid is still not recovered from COVID and inflation hit. And I think that's something which is impacting the two-wheeler sales. On the other side, we have the commercial vehicles, which continues to do well. And I think these are the two spots in auto, passenger vehicles and commercial vehicles, where we are positive on. And I believe that probably for the next 6 to 12 months, auto sector is in a sweet spot. And we have an overweight out there in our portfolios.
By the way, the market, I think, is in the green, right? I mean, the Nifty will come up on your screens, and I think we are back in the green by about 9 points, 8 points or so. There you go. So back in the green. I mean, let's just take a look at the Bank Nifty as well, which I think is a strong green bar, a green candle, not quite in the day on day, we're not above Friday's closing level, we're down just a little bit. But this is very sharp recoveries that we're seeing across the board at this point in time. Within, you're more constructive after the huge outperformance in IT now going forward, Pankaj. But any particular areas, or you'd, basically look at the top IT services names and not go into, specific themes there?
We believe that third quarter, we may see one more downgrade cycle. And I think after that, it will provide us an opportunity. Our preference initially will lie with the large cap IT companies. I think they have shown resilience. And going forward, I think one important thing which is changing is that attrition levels have started to come down. And even in the last quarter, we saw that the number of headcount additions in the IT companies was to the tune of 23,000 people. And that was one of the lowest in the last 4 quarters. So somewhere, I think the margins will get supported, which was a problem for the last few quarters in the IT industry. And even if demand continues to be a little sluggish, we may not see that impact on the profitability. So I think after the third quarter, one more downgrade cycle out there on earnings. And I think after that, IT starts looking to be a little attractive. And we will keep a close eye on that from our portfolio perspective.
Pankaj, thank you very much for joining in. That's Pankaj Tibrewal of Kotak Mahindra AMC. Let's now invite the management of DLF, Ashok Tyagi, the whole-time director. DLF is now joining us on the show now in our corporate corner. Mr. Tyagi, morning. This is Reema here. The last time we spoke to you, you were so bullish about luxury demand. Every time you would launch it on day 1, day 2, day 3, you would see blockbuster sales and pretty much sold out. How have things been in the festive season as well as in the first half of Q3, October as well as November? Any numbers that you could share which gives us an indication of demand?
Okay, so good morning, Reema. Clearly, while I would hesitate to share numbers, frankly, because of all the disclosure norms, but I can assure you that the luxury demand continues to be unabated. In fact, just at the fag end of Q2, I think maybe 28th or 27th of September, we had launched a project called Grove in DLF5 on the golf links, which are luxury independent floors, priced between 6 crores to 10 crores. And, in the first fortnight of October, virtually all of them have sold out, So I think the pace of absorption of good luxury, and by good luxury, I mean luxury which is well located by credible developers, I think that continues. Obviously, with the interest rate hikes, one always needs to be extremely cautious. But so far, I think the pace of demand absorption continues to be very strong, and not only on luxury, even in the other mid and the more premier segments as well.
Based on the pipeline, do you think you can sustain quarterly bookings above 2,000? You have for the last 4 quarters. At least if you could tell us, can your bookings be above 2,000 on a quarterly basis from here on?
Yes, we have guided the market to an annual sales target of 8,000 crores plus. And frankly, given the first 2 quarters, given the performance so far in Q3 and the pipeline for Q4, I think we are definitely very confident of hopefully breaching that.
All right. Hi, Mr. Tyagi. Good morning. And you're sounding a little bit cautious, but your undertone is more bullish, I think so. So this interest rate hikes that we have been talking about, as of now at least, no big impact. But though, you need to be a little bit cautious in case we do see more of the same. What about pricing? Have you pushed through a couple of price increases? Some of those input costs have started cooling off. Did you do all the price hikes earlier, or have you stalled on that?
So Nigel, the price hikes, not that we were hiking prices for the sort of, heck of it, but clearly we had followed a responsible price trajectory in the sense that we have increased prices, to cover the input costs, as you rightly said, which you are right, has begun sort of plateauing now, though it's plateauing at a higher level than what we would have liked it to be. And the second thing is clearly that, the price hikes in terms of, the next launches or the next edition of the launches of our products continue to be at price levels that were higher than the previous ones. And so far, the market seems to be absorbing them, pretty neatly, We have not faced a price-linked resistance so far, but obviously, given the entire macros, one does need to be cautious. You can't be reckless in pricing. The trajectory should still hopefully be positive, but you can't be reckless in pricing for sure.
All right, Mr. Tyagi, hi, good morning. Just to go back to that interest rate question, at what, there is presumably another 50, 60 basis points more to go from where we can see, how far out we can see in terms of rates going up, policy rates, etc. And that will reflect in what banks offer to customers. At what point does it start to hurt your set of customers, you think?
So, Prashant, historically, if you see, interest rates of ballpark 850, by interest, I mean mortgage interest rates. 850 people were comfortable paying. It was once they started approaching the nines that, it did start having a bearing on the demand. We began this cycle with interest rates at a historical low of 6.5, 6.6. They're, I think, now in the eight quarters to 8 halves. So my view, frankly, Prashant, is the next 50 basis points hike, the market should hopefully absorb. But, if because of any force majeure conditions or anything crazy going out there in the world, it sort of crosses 9 on a very sustained basis, then I think it could have a bearing. But again, the past is not always a guide to the future. But we believe that the market has done well to sustain the last 2 percentage basis points hike. Maybe it can sustain the next 50 odd basis points. But if it's a sustained curve still, then obviously everybody will need to be slightly more cautious. Hopefully, by whatever one reads of all the pink newspapers, we are in the last 50, 60 basis points of the interest rate hike. So hopefully, we have weathered this storm. But let's see how it pans out. But 850, 875, I think the market has demonstrated the consumers can absorb that.
Yeah, it can absorb. But 9, closer to 9, above 9, maybe we'll have to see.
Yeah.
But as you said, past performance is not an exact guide to what happens in the future, but we can take some kind of lessons from that. What about office leasing, Mr. Tyagi? How will that hold up? Again, using history as a guide, because there is this US recession. We're already seeing, freezes as far as new hiring is concerned. General cost cutting, right, in the US from the top companies, IT companies as well. So how is that likely to impact you?
So the office leasing has been a complex market. The fact is that our office vacancy levels, which used to be historically 4 to 5%, had shot up to 15, 16% in the midst of COVID. The good news is that they're inching back to normalcy. I think today now we are back to an occupancy level of 90% plus. That means the vacancy levels of just under 10%, and hopefully that direction continues. People are back to signing reasonably big leases. The change is that we are observing, at least in our premium office spaces, is that a large part of the spaces are being leased by captives of the BFSI and the foreign corporates. The third-party IT industry, you are right, may have some bearing on all that's happening, but a large part of the global captives continue to look at India as a very strong destination. In fact, if you will, during COVID, India has sort of demonstrated even further its utility and reliability, to the global business chain, in terms of how we continue to provide the services as a country and as an industry. We are seeing the office leasing coming back to normalcy. We have 2 new buildings in Gurgaon called downtowns, and both of them have been completely pre-leased. We have launched the 3rd tower. We are in the midst of putting up a 2.5 odd million square feet office complex in Chennai, which also is about, I think, at least half of it is pre-leased. During the midst of the COVID, as we had reported earlier, we signed one of the biggest, captive leases for a multinational bank, which actually is their biggest back office globally. So I think you're right that work from home, recession, some of these things could have a bearing. But I think we are definitely back from the troughs of the 2020s and early 21s. And I think the leasing momentum is gaining all over again. On the offices side, retail, of course, has been a completely different story, because retail has been a completely V-shaped recovery. And, frankly, retail in most segments today is actually doing better than even pre-pandemic.
It's more like a K-shaped, sir, but you are placed at the right side of the K on the retail side where we are seeing that recovery. Just a quick update. There was an auction notice issued by lenders for the Ambience Mall in Delhi. And you had previously indicated that you're open to exploring whether you want to go ahead and acquire Ambience Mall. We don't have any update on that. So if you could help us provide any auction dates, have you done some due diligence?
To the best of our knowledge, while the auction notice had been issued, I don't think there's been any downstream steps that have been taken by the lenders, at least not that we are aware of, frankly. I mean, it's a well-located mall from our standpoint, but frankly, these are very hypothetical questions till such time that there's actually a trade in the market, which I think, as we speak right now, doesn't seem to be there.
There's no movement on that front then, Mr. Tyagi.
Yeah.
Okay. What about Ashoka Hotel? You told us in the past it's not going to be an ego issue for you, but any progress there? Have you changed your mind?
No. Yeah. I mean, 2 days or 3 days back only they have come up with the initial reserve price.
Is it?
So I mean,
that reserve price is looking too high.
I mean, it's 7,400 crores. So it's almost like just short of $1 billion. So anyway, I think the good news is that we have enough land banks of ours in NCR and in some of the other geographies where we want to play. So we don't need to be buying land to support our growth momentum. We have enough growth. We have enough land parcel to sustain our growth momentum, both in the offices and the retail malls and the residential developments. I mean, if there's something truly nice and strategic at hopefully an opportunistic pricing, one should look at that. But clearly, we don't need to be buying land for the sake of growth.
All right, Mr. Tyagi, we'll leave it there. Thank you very much. Great speaking with you. It's always a good conversation, sir. Understanding what's happening in the real estate space and DLF in particular. Speak with you soon again. The market is up 24 points. So it's a the sharp cut. Immediately the dip is bought and we are basically at the day's high, although it's only 20 points so far. 18,532, creeping higher slowly but steadily, like what we saw on Friday. We'll take a quick commercial break here. Next up, we have the management of MedPlus Health Services. They are, of course, building out one of the largest physical pharmacy